Two halves. Imagine waking up to money hitting your bank account while you sleep. Sounds like a dream, right? What if I told you there's a way to make that happen? But the choice you make could either skyrocket your wealth or leave you stuck in a financial trap. Today, we're diving into the ultimate showdown. Dividend stocks versus rental properties. Which one builds passive income faster? Stick around because by the end of this video, you'll know exactly which path could lead you to financial freedom. And I'm throwing in a surprising twist that could change everything you thought you knew about investing. Here's the big question. Why do so many people chase passive income, yet most never figure out the best way to get there? It's like they're standing at a crossroads with two signs, one pointing to dividend stocks, the other to rental properties, but no map to tell them which road leads to riches. The problem, both paths promise money while you sleep, but they come with wildly different risks, rewards, and secrets nobody talks about. Let's break it down, step by step, and uncover which one's the real deal for building passive income fast. First, let's talk about what passive income really is. It's money that flows in without you clocking in for a 9-to-5. Think of it like planting a money tree. Once it's growing, it keeps dropping cash. Dividend stocks and rental properties are two of the most popular ways to plant that tree, but they're not created equal. One could have you sipping coffee on a beach in no time, while the other might keep you up at night dealing with headaches you never saw coming. Let's start with dividend stocks. Picture this. You buy shares in a company like Apple and every few months they send you a check just for owning their stock. Sounds pretty sweet, right? These payments, called dividends, are your cut of the company's profits. In 2024, top dividend stocks like those in the S&P 500 are paying anywhere from 2% to 6% annually. That means if you invest $10,000 in a stock with a 4% dividend yield, you're pocketing $400 a year without lifting a finger. But here's the kicker. Some companies, known as dividend aristocrats, have raised their payouts every year for decades. Imagine getting a raise without asking for it every single year. That's the power of dividends. They're like a loyal friend who keeps sending you money just for sticking around. But wait, before you think stocks are the golden ticket, there's a catch. The stock market can be a roller coaster. One day your portfolio is up, the next it's tanking because of a tweet or a bad earnings report. In 2022, the S&P 500 dropped nearly 20%, wiping out billions in value. If you're relying on dividends for income, that kind of volatility can feel like a punch to the gut. Plus, not all companies are reliable. Some cut their dividends when times get tough, leaving you high and dry. So, while dividend stocks can be a passive income powerhouse, they're not without risks. Are you starting to see why this choice isn't so simple? Now, let's flip to rental properties. Imagine owning a cozy apartment in a bustling city like Austin or Miami. Every month, your tenant wires you $1,500 in rent. After expenses, you're clearing $800 a month, $9,600 a year. That's passive income you can feel, right? Real estate has been a wealth-building machine for centuries. Unlike stocks, properties are tangible. You can walk through them, touch the walls, and know your money's tied to something real. In 2024, rental yields in hot markets average 5 to 8%, sometimes higher in up-and-coming areas. Plus, your property can appreciate over time. A $200,000 home today could be worth $300,000 in a decade, giving you a double whammy of rent and value growth. But hold up, here's where things get juicy. Owning a rental isn't all sunshine and direct deposits. Tenants can be a nightmare. Picture this. It's 2 a.m. and your phone's blowing up because a pipe burst, flooding your rental. Or worse, your tenant stops paying, and you're stuck in a legal battle to evict them. In 2023, eviction processes in some U.S. states took up to 6 months, costing landlords thousands. And don't forget maintenance: roofs leak, AC units die, and those repairs eat into your profits. Suddenly, that passive income feels like a second job. Are you starting to wonder if real estate's worth the hype? Let's talk money, because this is where the rubber meets the road. Dividend stocks are accessible to almost anyone. You can start with as little as $100 on platforms like Robinhood or Fidelity. Want to invest $1,000? You could own a slice of dozens of companies through an ETF, like the Vanguard Dividend Appreciation Fund. No loans, no credit checks, just click and buy. Rentals. That's a different beast. In 2024, the median home price in the US is around $400,000. Even with a 20% down payment, you're shelling out $80,000, plus closing costs, taxes, and insurance. If you don't have that kind of cash, you're looking at mortgages, which means interest payments eating into your profits. So, if you're starting with limited funds, stocks might seem like the clear winner. But don't make up your mind just yet. Here's the first big surprise. Dividends can grow faster than you think. Let's say you invest $50,000 in a stock with a 3% yield. That's $1,500 a year. But if that company raises its dividend by 7% annually, a common rate for dividend aristocrats, in 10 years, your income could double to $3,000 without adding a dime. Now, compare that to a rental property. A $50,000 down payment might buy you a $250,000 property with $2,000 monthly rent. After expenses like taxes, insurance, and maintenance, you might net $1,200 a month, or $14,400 a year. Sounds better, right? But rents don't grow as fast. In most markets, rent increases average 3 to 4% per year. In a decade, your rental income might climb to $19,000. But you're dealing with headaches stocks don't have. Which one's pulling ahead now? Let's talk about risks, because this is where things get real. With stocks, your biggest enemy is the market. A crash like 2008 could slash your portfolio's value by 40%, even if your dividends keep coming. But here's the second shock. You don't have to sell during a crash. If you pick solid companies, those dividends keep flowing, and you can reinvest them to buy more shares at bargain prices. Rentals. The risks are different, but just as brutal. Vacancies can kill your cash flow. In 2024, some markets saw vacancy rates hit 10%, meaning your property could sit empty for months. And if the housing market tanks, your property's value could drop, leaving you underwater on your mortgage. Imagine owing $300,000 on a house worth $200,000. That's a nightmare stocks don't face. Now let's hit liquidity, because this is a game changer. Dividend stocks are like cash in your pocket. Need money? Sell your shares in seconds on any trading app. In 2024, platforms like Trade process trades instantly, with funds available in days. Real estate? Good luck. Selling a property can take months, even in a hot market. And if you're desperate to sell, you might have to slash your price. Want to cash out just a piece of your property? You can't unless you're selling to a shark who lowballs you. Stocks give you flexibility. Rentals tie your money up like a hostage. Here's the third surprise. Taxes can make or break your passive income. Dividends are taxed as ordinary income or capital gains, depending on your bracket. In 2024, if you're in the 22% tax bracket, a $10,000 dividend payout could lose $2,200 to Uncle Sam. Ouch. Rentals, though, have a secret weapon: deductions. You can write off mortgage interest, property taxes, insurance, and even depreciation. In some cases, these deductions can slash your tax bill to zero, letting you keep more of your rental income. But here's the twist. Managing those deductions requires paperwork, accountants, and time. Are you ready to play tax detective? Or, do you want the simplicity of dividends? Let's talk effort. Dividend stocks are the ultimate set-down forgetit. Pick a few solid companies or an ETF, invest, and let the dividends roll in. You might spend an hour a year checking your portfolio. Rentals? They're like adopting a needy pet. You're dealing with tenants, repairs, and local regulations. Even if you hire a property manager, they'll charge 8 to 10% of your rent, eating into your profits. In 2024, the average property manager in the US costs $150, $200 a month per property. That's $2,400 a year gone before you even count repairs. Passive? Not quite that so. Which one's better? It depends on you. If you've got $10,000 and want to start small, dividend stocks are your ticket. They're low effort, liquid, and can grow over time. If you've got $50,000 or more and don't mind some hustle, rentals offer higher cash flow and tax breaks, but you're signing up for more work. Here's the final twist. You don't have to choose. Some of the smartest investors mix both dividends for quick cash flow and rentals for long-term wealth. Imagine a portfolio spitting out $500 a month in dividends and a rental property netting $1,000. That's $18,000 a year in passive income, and you're diversified against market crashes and tenant drama. So, what's your move? Start with what fits your life. If you're new, try a dividend ETF. $100 gets you in the game. If you're ready for real estate, look into smaller markets or REITs, which let you invest in property without the landlord headaches. The key is to start now. Every day you wait is a day you're not building your money tree. If you loved this breakdown, smash that like button. It helps us keep bringing you content like this. And if you want more tips on building wealth, hit that subscribe button and ring the bell so you never miss a video. Tell me in the comments, are you team dividends, team rentals, or both? Let's keep this conversation going.